Welcome to our monthly View from the Edge for April 2021. I'm Fritz, the Chief Investment Strategist here, and I'm joined here once again by Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3 Edge Asset Management. As we do at the beginning of each month, Eric and I will provide a brief capital markets update and then discuss our most recent outlook for the markets, which is based on our proprietary research model. We're making a slight adjustment to our monthly View from the Edge video. In order to be respectful of everyone's time, we're going to focus on those asset classes where we either saw a change in our outlook from March to April or any asset class that we feel it would be important to mention in a bit more detail. As a reminder, the full print version of our monthly View from the Edge newsletter, which contains our outlook for each of the 8 major asset classes that we follow, is available on our website at 3edgeam.com. So let's get started. Brief recap of the markets this week. Stocks rose for the third week in a row. The S&P 500 closed at another all-time high during the week, as investors shrugged off a larger than expected increase in the producer price index, which climbed more than forecast, as costs increased for goods and services, sending another signal that inflationary pressures continue to build across the U.S. economy. However, with stocks continuing to advance, it seems that investors are believing what they are hearing from the Fed and that any increase in inflation will be short-lived as the economy rebounds from the economic slowdown brought on by the coronavirus global pandemic. The strong number for PPI followed earlier strong reports in April that the ISM manufacturing index had increased to over 64% in March, which was the highest reading since 1983. During the first 3 months of the year, the yield on U.S. Treasuries also increased, with the 10-year increasing from below 1% in January to as high as 1.77%, which was a 14-month high. However, the rapid rise in U.S. Treasury yields didn't seem to cause a problem for the equity markets in the first quarter. So, an important question facing investors currently is just how strong an economic rebound is already priced in to the equity markets. Or if you think about that another way, how strong does the economic rebound from the coronavirus global pandemic need to be to keep equities moving higher? So, let's now get to our model outlook for the month. And why don't we start by showing you the chart? This chart comes again from the newsletter, which you can get from our website. And as we can see from the chart, from the newsletter, our model remains generally positive towards the equity markets. What we see here is that European equities are slightly more positive this month than they were in March. And in addition, although we remain positive towards gold longer term, we can see that gold is slightly less positive this month than it was in March. So let me bring Eric into the conversation now, and let's dig into our model research for the month of April 2021 and beyond. And Eric, maybe we could begin with U.S. equities, which I know haven't necessarily changed for us from month to month, but once again this week we saw the S&P climb to a new all-time high. So what is our model telling us about the U.S. equity market?
Yeah, Fritz, that's exactly right. The major U.S. equity market indices have reached new all-time highs, and as this month's title suggests, this positive momentum is serving to further bolster this idea of keeping this euphoria euphoric. Also a positive for U.S. equities, continued monetary stimulus. We've now seen the other pillar of fiscal stimulus come through with the passage of the $1.9 trillion relief bill in March. Also positive, if you can believe it, we've been talking about this for months, right? High yield credit spreads, they not only remain narrow, they're continuing to tighten. If you can, it's remarkable, but we watch that like a hawk. Also positive, a steepening global yield curve measure that we calculate for the U.S. This signals prospects for higher growth in the future. So a lot of positives we're listing here. So as we've mentioned, there's extreme, by our measure, this new record level of overvaluation of the U.S. equity market continues to be a headwind to larger allocations in client portfolios. The rise in the 10-year yield in particular that you touched on, that calls attention also to some concern around large cap U.S. growth stocks as well.
Excellent. So let's turn our attention to Asia and the Japanese equity market, which again didn't change necessarily from month to month, but continues to be our highest ranked equity asset class. So maybe you could just get into a little detail there and what the model is seeing.
Yeah, Japanese equities do remain the most attractive, like you said, of the asset classes that we're modeling. They have more compelling valuations than the other equity markets that we model. They also benefit from the narrowing of the high yield credit spreads that we've talked about. They too have steepening global yield curve measures by our calculation. We're seeing continued monetary stimulus from the Bank of Japan. And there's continuing positive investor psychology that quite frankly, may continue this positive momentum on the heels of strong projected earnings for the remainder of 2021. Japan's also dealt much better with the coronavirus pandemic than many other countries.
Yeah.
And given its export focus, it's well positioned to benefit from a rebound in global economic activity if that really does pick up in a greater way.
Excellent. You mentioned the better management of coronavirus in Japan. I was really struck by a statistic that I saw recently, and that was that Japan's death toll per million people from the coronavirus was somewhere around 73 per million, compared with 1,700 deaths per million in the United States. So, yeah, quite a difference there. So great. So let's move on to Europe and the European equity markets, and they have actually improved in terms of our outlook for those European equities recently. So what are we seeing there that's making them look a bit more attractive in April?
Yeah, European equities should continue to benefit from the continued and quite frankly, just absolutely extraordinary monetary and fiscal stimulus that they're rolling out there. And this is required to support the region because they've had a slower recovery than most, and they've had very inconsistent progress on vaccination so far. So, also throughout much of the first quarter, we've seen this strengthening in the US dollar relative to the euro. And that could be a positive for European equities since, like Japan, which is also export focused, the strong dollar can help European exporters, either expand market share and or profit margins due to the price advantages that you get when you're an export company when you have a lower exchange rate. So that's also a positive. Yeah.
Excellent. Yeah, it's interesting about Europe because in some respects, one of the positives is they're forced. The ECB is forced to try to prop up the economy because they've had more issues with coronavirus and the rollout of the vaccine. So great. Let's switch now and take a look at gold. And again, as I said, gold has had a very good performance over the past 12 months. It struggled here in the first quarter of 2021, and it's slightly less positive in terms of our model outlook now in April than it was in March. So maybe some detail there about both the short-term outlook and the medium-longer-term outlook for gold.
So gold is struggled in Q1, as you suggested, but a couple of things on that. One, it's actually done pretty well over the past 12 months.
Right.
And two, it does continue to be supported by negative real rates, which we're seeing. There are still negative real interest rates. They're nominal rates minus inflation expectations, that is. As you noted, the real rates started the year around minus 1.1%. They're now at minus 0.6%, and that's a headwind, short to intermediate term, this rise in real yields that we've seen. But as a reminder, gold is an asset class that over the long term, it can serve this critical portfolio hedge against the prospects of future and further central bank money printing and financial repression. That is the interventions by central banks, which ultimately hold interest rates lower than they otherwise would be without those interventions. So longer term, we still like it. Short to intermediate term, concerns about the rising real rates.
Great. Let's touch on the bond market just real quick. And I know that bonds haven't necessarily changed in terms of their attractiveness from March to April, but the backup in interest rates was so, fairly dramatic in the first quarter. So maybe it'd be helpful to just touch on that briefly.
Yeah, I mean, you cited some of the numbers early on. We're going to just throw some rough numbers out there, but at the beginning of the year, nominal bond yields were around the 10-year about 0.9%, and by the end of the quarter finished about 1.7%. So that's a 80 basis point or 0.8% increase over the quarter. Now, if you take a look at the real yields as given by the TIPS market, that is the Treasury inflation protected securities market, those yields, as we pointed out, started at minus 1.1 and finished the quarter at minus 0.6. That's a 50 basis point or 0.5% increase. So of that 80 basis point increase that we saw in the 10-year nominal yield, a little over half of it was due to the expectation for real yields going up, which is a positive for growth, generally speaking, in an economy, while the other 30 basis points was due to increased inflation expectations. And I think along those lines, there's been a lot of discussion about inflation and what the inflation numbers may be going forward. And I think we are likely to see some more eye-popping type of numbers in the months ahead, particularly when compared year-on-year basis. Things like GDP, employment, and CPI. But these may be transitory, as you alluded to earlier as well. So, overall, with these higher yields, U.S. Treasuries are still what we consider to be providing an unattractive risk-return trade-off. As these yields still less than the market's expected inflation rate across nearly all the maturities. And should interest rates keep moving higher, we're going to see, bond market investors and holders of bonds are going to face, the prospect of further capital depreciation. We saw a good deal of that in Q1, when looking at the negative prints that we saw over a variety of bond market indices.
Yeah, I mean, the first quarter results for bonds for the Treasury market was, in the longer end anyway, was something like the worst performance in 4 decades for the U.S. Treasury market. So very interesting. Well, Eric, thank you for getting us caught up with the highlights of our View from the Edge newsletter, which is available on our website. It's going to be an interesting time for the markets as the U.S. and the world emerge from the coronavirus global pandemic. Eric and I will be back once again in early May with the next edition of our View from the Edge. And meanwhile, Steve Cucchiaro and I will be back at the end of next week with the latest edition of the 3 Edge Week in Review. As a reminder, all of our videos are available on our 3 Edge YouTube channel and at our website, 3edgeam.com. Please feel free to share our videos with anyone who you think might benefit from listening. On behalf of everyone here at 3 Edge, we urge you to remain safe, stay strong, keep the faith, and thanks for listening.